Okay, so you're looking to invest in REITs, real estate investment trusts. The question that comes up is how do you buy them at a cheap price so that you can reap the rewards over the long term? I used to work for one of the largest REITs in Canada, and in this video, I'm going to share with you the best methods to use to be able to value REITs. All of this step by step so you can learn the process of REIT valuation. Okay, so the first REIT valuation method is the net asset value method. And this method is based on the premise that a REIT is basically just a collection of properties that you can value and then sum the values of all those properties to find the overall value of the REIT. So if you remember, the way you value an individual property is that you take the NOI, the net operating income. So let's say that a property has an NOI of $100,000. So $100,000. And then the cap rate, let's say that the cap rate for this type of property is around 6%. So the way you find the value of that property is you take the NOI and you divide it by the cap rate. And this tells you that in this case, the property should be worth about $1.6 million. So with this information, what you can do is create a super helpful table like this. So in this case, we have a whole bunch of REITs. And what we're gonna do is first, we're gonna use the white price function that comes from YSheets to get the market cap of all these REITs. And if you're interested in knowing how YSheets works, we have various tutorials on the channel that you can check out. So now we have the market cap, and the next step is to get the operating income. So in that case, we're gonna select the symbol, the parameters, or the parameter in this case is the operating income. We want TTM, the trailing 12 months, so we can compare the company's operating income evenly despite any type of seasonality taking place. Lock this cell. And now what we can do is just drag this across so we get this for all the different companies. And now the only thing that we're missing is the cap rate. Now let's say that of all the list of REITs that we had before, let's say all of them were office REITs. What you can then go ahead and do is just Google US office cap rate report and then just click on one of the links. By the way, this is an excellent source if you're looking for cap rates and other type of real estate research. And then here, if we scroll down on this report, you can see here figure 11 is the estimated stabilized office cap rate by the different market tiers. So let's say that all of them were tier 1 office markets. You can see what the cap rate is going to look like. So here you can see the trend, but right now for 2021, you can see the market cap seems to be about 6%. So what you could then go ahead and do is in your list of REITs, you could just enter 6.03%. as the cap rate that you would utilize to value all these REITs. So let's say we do that, and then remember the formula. So you take the operating income divided by the cap rate, and that gives you the value of the REIT. So if you apply this across all the REITs, you could then compare the net asset value with the market cap, which is the market value of the REIT, and realized, okay, it seems like this company is overvalued, undervalued, fairly valued, and you could use that information to make some good stock investments or REIT investment decisions in this case. The next REIT valuation method is to use FFO or AFFO. So FFO stands for funds from operations. And basically, as you can see in this image, the way that is calculated is that you take the net income, add any depreciation expense plus amortization expense plus losses on sale of assets. In this case, it could be properties or whatnot for REITs, minus any gains on the sales of assets plus the interest income. So what you can also do is to build this stock list right here, and then here we have the market cap. And what you can do is the FFO is a measure that needs to be reported by every REIT. So for example, here we're looking at Equinix. This is a big REIT in the US. And as you can see here on their financial reports, if you go to the annual part here, annual guidance summary, you can see that the FFO is expected to be between $28 and $29 per share. So let's say that this was the case for all the REITs, just for the sake of argument. So I would go ahead, enter the individual FFO per share for all these REITs. So let's say that it's 28 for all the companies. Format this, make this adjustment, and then let's say that it's the same. What you can then do is to sort of find what is the FFO multiple that the company is trading at. This is sort of like the PE ratio for REITs. So if I look at FFO multiple, and then what you would do is first, let's move this to the right so we can organize our data better. And then here, we're gonna copy this here, except we're gonna change it to shares outstanding. And now all we have to do is in the Wise price function, we're gonna add shares outstanding as a parameter. So this is gonna give us the market cap and the shares outstanding. Here, the way that we're gonna format it is in this accounting format. And we're gonna get rid of 2 decimal places. There you go. And now the FFO multiple is gonna be easy to do. So in that case, all you need to do is take this times the number of shares. So that would tell you the overall company FFO. And then you would divide the market cap. So that would be the price, so to speak, divided by the FFO, or like if it was a PE, the net income, in this case is the FFO. And that would tell you the multiple at which the REIT is trading at. So assuming these FFO numbers were right, this would be the actual number. And then you can be like, oh, you know what? It looks like this REIT is trading at a very low multiple. Therefore, it could be heavily undervalued. The only thing to keep in mind is that this valuation method works really well when you're analyzing REITs that are in the same type of industry, which in this case, it's not. The next REIT valuation method is the PE ratio method. So the way this works is very simple and very similar to the FFO method. So you're gonna use the Wise price function. We're gonna enter all the tickers, all the REITs, and then we're gonna select PE. And what's gonna happen is that you're gonna get all the PE ratios for all the different REITs. And since this is a live metric, what you can do is go to the Wise price function menu, refresh data, and the data will automatically refresh for you. Once you have this data, again, the key is to compare REITs that are in the same industry, so you can analyze, okay, these companies have very similar types of assets on their portfolio, and yet this company is only trading for 15 times its earnings, whereas this other company, even though it's very similar, it's trading for 30. That way you can find undervalued companies in a very simple way. The next REIT valuation method is the dividend discount model. And so the way this works is very simple. All you have to do is set up in your spreadsheet a formula like this. So the blue items are the inputs and the green is the output. So the way this works is simple. You enter the discount rate. So this is basically what you want to get back as a return of the company. You can also use the WACC. That's a pretty good measure as well. And then you enter the growth rate that you expect in terms of the dividend payments per year. Here you're going to get the last annual dividend. So for that, we're going to use the Wise function. Enter the symbol, dividend. And we're going to enter LQ. So this provides us with the latest quarterly dividend. And we can also multiply this by 4 because there's 4 quarters in a year. As you can see, this provides you with the annual dividend, and then the REIT value formula is very simple. You take the last annual payment and you divide this by the discount rate minus the growth rate. And this will tell you how much you should pay per share for this particular REIT. Something that can also help you is if you use the Wise price function, you can enter the ticker and then dividend. And what this is going to do is return all the dividend payments that the company has made in the past. And as you can see from here, you can do a percentage change formula so that you can see how the dividend payments have grown over time and how they will grow likely in the future. But again, this is all part of your own research. If you're a dividend type investor, this is a great way to value REITs. The last relevant REIT valuation method that you can use is the DCF. So in this case, I've created this model that gets data from Y-sheets. It provides you with the different financial statements, the income statement, the balance sheet, cash flow. And then from those items, what it's going to do is it's going to make different assumptions in terms of growth and whatnot for the different items. And again, these are just things that you can change on your own. It's really up to you the way you want to analyze and the way you want to present your assumptions. Right now, these are just garbage numbers, so I wouldn't really pay much attention to them. The cool thing is that you can change the company ticker, and then obviously the whole REIT data will update. And then what happens is that based on those assumptions, you basically estimate the free cash flows of that REIT. And then from there, the present value is taken to be able to calculate the intrinsic value of the stock. And as you can see at the end, you have a potential downside and downside, of course, with different assumptions that would yield different results. So the key here is to make sure that you have the right assumptions in your DCF. And by the way, if you want to get this template, this is also available on Y-sheets. If you go to Y's templates, you will see it right here, discounted cash flow. So once you click on it, it will automatically download, and then you can get all the stock data automatically for this model, and of course make any modifications that you would like. Now you know the entire REIT valuation process, as well as how to automate some of the key components. Remember, depending on the REIT and your unique investment style, the valuation method that you may use may be different. I hope you enjoyed this video. If you did, please make sure to subscribe and turn on the notifications on so that way you get notified every time we release a new video like this. That's going to allow you to become a more successful investor over the long term. I'll see you in the next one.